Welcome back to Capital Crew, your go-to source for all things finance and beyond. Today, we're diving deep into the world of commodities and exploring a topic that's making headlines around the globe. Brace yourselves because conflicts and resurgent demand are about to collide in a way that's nothing short of radioactive. In this episode, we'll uncover the explosive reasons behind the unprecedented surge in uranium prices. But before we get to the nitty-gritty, if you're new here, don't forget to hit that subscribe button and ring the notification bell so you never miss out on the latest financial insights from Capital Crew. Alright, let's dive right into the heart of the matter. Why are uranium prices skyrocketing, and what does it mean for investors, economies, and the world as a whole? Stick around as we unravel the secrets behind this nuclear phenomenon. But first, let's start with the basics. What exactly is driving the uranium market to radioactive heights? And now that we've set the stage for the uranium market's recent turbulence, let's dive deeper into the forces at play and explore why uranium prices are soaring. As we mentioned earlier, the invasion of Ukraine by Russia sent shockwaves through the nuclear industry. Ukraine, heavily reliant on Russia for uranium, was quick to secure a 12-year deal with Canada to ensure a stable supply of this essential fuel for its reactors. Meanwhile, European utilities, also dependent on Russian uranium, scrambled to maximize their existing contracts, fearing potential shortages. The situation became particularly tense for operators in Finland and Eastern Europe who owned Russian-made reactors. These reactors had unique requirements, and finding an alternative supplier for the specialized uranium rods took a year. Today, they're still searching for the metal needed to restart their nuclear operations. This last-minute scramble for uranium is highly unusual in a market where utilities typically receive deliveries 2 to 3 years after signing a contract. The urgency of the situation paints a clear picture of the impact of the ongoing geopolitical conflicts on the uranium market. But the crisis in Ukraine is just one part of the story. Even before these recent events, the uranium market was facing significant challenges. Rising global demand for low-carbon sources and the growing urgency to combat climate change have brought nuclear energy back into the spotlight. Approximately 60 new reactors are currently under construction worldwide, which is expected to increase the world's nuclear power generation capacity by 15% in the coming decade. Furthermore, small modular reactors, which are cost-effective and quick to build, are gaining traction and could further boost demand for uranium. Financial markets have also taken notice of uranium's promising future. In recent years, listed funds like the Sprott Physical Uranium Trust and Yellowcake have been actively buying uranium, collectively acquiring a substantial portion of annual demand. These funds are in it for the long haul, with no fixed date or target price for liquidating their holdings. However, while demand surges, the supply side of the uranium market is facing uncertainty. Traditional uranium mining countries like Russia, Canada, and Kazakhstan have been dealing with production challenges. A coup in Niger has put a significant portion of mine supply at risk, and logistical issues are causing disruptions in Kazakhstan's shipments. Consequently, the uranium market has been in a deficit since 2018, and while outright shortages are unlikely, major utilities are drawing down their stockpiles. Fortunately, fuel blocks inserted into operating reactors still have 1 to 3 years of life left, with possible extensions. Most reactors have the next block ready to go, reducing the risk of immediate supply shortages. Looking ahead, there's room for the supply side to respond. Major uranium producers like Cameco and Kazatomprom have unused capacity and could potentially increase global supply by 15 to 20% within 12 to 18 months. If necessary, higher prices could incentivize the opening of new mines, helping to stabilize the market. In conclusion, the uranium market is currently experiencing a perfect storm of resurgent demand and supply challenges driven by geopolitical events and the world's growing appetite for clean energy sources. While uranium prices have surged to their highest levels in years, utilities have the means to absorb these price shocks, as uranium's cost is a relatively small part of nuclear power plant operation expenses. So expect to see high uranium prices for the foreseeable future, but with the likelihood of a surplus returning by the middle of the decade. This scenario, while financially significant, is unlikely to have a significant impact on the cost of electricity from nuclear power plants, making it more of a concern for spectators than the average consumer. Thank you all for joining us on this journey through the dynamic world of uranium prices. If you found this exploration fascinating, then don't forget to hit that like button, share this video with fellow enthusiasts, and subscribe to Capital Crew for more in-depth financial insights. Stay tuned for our next episode, where we'll continue to unravel the mysteries of the financial world. Until then, keep your eyes on the market, and we'll see you next time.